The 2026 housing shift nobody is talking about. The year 2026 will not be remembered as a housing crash. Pause. It will not be remembered as a historic boom either. Short pause. But it will be remembered as the year the housing market finally started moving again. Let that sink in. For years, the market felt frozen. Buyers were waiting. Sellers were refusing. Inventory barely moved. And yet, prices stayed high. That confused a lot of people. So today, we're going to break down why 2026 is different. Not louder, not dramatic, but quietly important. This video is based on two major reports. One focuses on mortgage rates across the United States. The other focuses on the Bay Area housing market. Separately, they tell part of the story. Together, they explain what's actually happening. Pause. And more importantly, who wins next? For most of the past 5 years, the housing market was frozen. Not because people didn't want to move, but because moving came with a cost, a painful one. Millions of homeowners locked in mortgage rates below 3%, some below 2%. Those rates were once in a lifetime. Selling meant giving them up, so people stayed. They delayed moves. They stayed in homes that no longer fit their families. They stayed in cities they wanted to leave, because financially, it made sense. This became known as the golden handcuffs. Pause. As long as those handcuffs existed, inventory stayed low, prices stayed elevated, and buyers kept fighting over fewer homes. But that era is ending, and here's why. According to Axios, something critical changed in 2026. For the first time since the pandemic, more homeowners now have mortgage rates above 6% than those locked in ultra-low rates. Pause. This is not about numbers. It's about psychology. When everyone has a perfect rate, nobody wants to move. When rates normalize, fear fades. People stop saying, "I can never give this up," and start saying, "Maybe now is fine." Short pause. This doesn't create a flood of homes, but it creates movement, and movement is everything. Housing markets don't need crashes, they need circulation. Let's be clear, mortgage rates did not collapse in 2026. Pause. There is no return to 3%, no emergency rescue, no miracle. Instead, rates settled. 30-year fixed mortgages now sit in the low to mid 6% range. That doesn't sound exciting, but housing doesn't react to excitement. It reacts to predictability. Pause. Buyers don't need cheap money. They need stable money. And once rates stopped swinging wildly, people re-entered the market. Mortgage applications increased, refinancing returned, sales slowly picked up. Not fast, not explosive, but consistent. Nowhere is this shift more visible than the Bay Area. According to SFGate, experts do not expect a boom in 2026. They also do not expect a crash. Instead, they expect pressure, affordability pressure. In San Francisco and San Jose, a typical household would need over half of their income just to afford a mortgage. Pause. That's with a large down payment. That reality caps demand, which means the market splits. And split markets behave very differently. San Francisco is not one market. It's several markets stacked together. Luxury neighborhoods remain strong. Pacific Heights, Marina, Cow Hollow. These areas hit record prices in 2025, and they stayed resilient. Why? Cash buyers, stock market wealth, limited inventory. Pause. But condos tell a different story. HOA fees rise. Insurance costs increase. Buyers hesitate. Homes sit longer. San Francisco isn't collapsing. It's concentrating. San Jose faces a different problem: affordability. Even high-income tech workers feel stretched. Single-family homes still attract demand, but buyers negotiate more. They pause. They calculate. This is not panic. It's discipline. Homes no longer sell instantly, and that changes seller behavior. Oakland and the East Bay sit in the middle. Too expensive to feel affordable, too uncertain to feel safe. Some neighborhoods remain competitive. Others slow dramatically. Buyers want value, but they also want stability, and stability costs money. Pause. That limits demand.
More affordable Bay Area suburbs remain competitive. Why? Because buyers are compromising. Smaller homes, longer commutes, older properties. Inventory remains thin. Multiple offers still happen. Not everywhere, but enough to prevent price drops. This isn't desperation, it's adaptation. Here's who wins. Cash buyers. Move-up buyers with equity. Sellers who price realistically. Pause. Here's who struggles. First-time buyers without assistance. Investors chasing appreciation only. Anyone waiting for a dramatic crash. 2026 rewards flexibility, not timing. Who loses? People stuck in old narratives, waiting for 3% rates, expecting 2021 demand, believing prices must fall sharply. Housing doesn't move on logic, it moves on behavior, and behavior already shifted.
This is not 2008. Lending standards are tighter. Inventory is lower. Homeowners have equity. There is no forced selling wave. There is no credit collapse. There is frustration. There is stagnation. But those are not crashes. Myth 1. Rates are going back to 3%. They are not. Myth 2. The Bay Area is collapsing. It is not. Myth 3. Waiting is always safer. It isn't. Housing punishes certainty. If you're a buyer, patience matters more than fear. If you're a seller, realism matters more than pride. If you're an investor, cash flow matters again. Narratives don't pay mortgages. The real story of 2026 is not price, it's psychology. The market is no longer frozen, but it's not confident either. It's cautious, and cautious markets move slowly, but they do move. 2026 won't make headlines, but it will shape the decade, and those who understand it early win quietly.